Brad Williams, Frugal Finance, Mortgage-Backed Securities, an overview. Mortgage-backed securities are financial instruments backed by pools of home loans. These investments function similar to bonds, providing investors with periodic payments derived from mortgage payments. Financial institutions bundle these loans and sell them as securities to investors, facilitating liquidity in the housing market. Understanding mortgage-backed securities are structured by aggregating mortgage loans and selling shares of the resulting pool to investors. The returns come from principal and interest payments made by borrowers. The modern mortgage-backed security market has evolved significantly, especially following the 2007-2008 financial crisis, which was largely driven by subprime mortgage defaults and risky financial derivatives. Today, mortgage-backed securities are a crucial component of the financial system, subject to enhanced regulatory oversight. A significant portion of U.S. mortgages are packaged into mortgage-backed securities, making them a key instrument in the housing finance sector. How mortgage-backed securities work? Loan origination. Bank or financial institution issue mortgage loans to homebuyers. Pooling. These loans are grouped based on similar characteristics such as interest rates and maturity periods. Securitization. The pooled mortgages are sold to government-sponsored enterprises or private institutions which create mortgage-backed securities. Issuance. Mortgage-backed securities are sold to investors with returns linked to mortgage repayments. Servicing. Mortgage servicers collect monthly payments from borrowers and distribute them to investors. Investment. Investors receive steady income streams, making mortgage-backs an attractive fixed income investment. Types of mortgage-backed securities. Mortgage-backed securities can be broadly characterized into two main types. Pass-through securities. Mortgage payments flow directly to investors with maturities typically ranging from 5 to 30 years. Collateralized mortgage obligations. These securities consist of tranches with varying risk levels and maturity periods, allowing investors to choose risk exposure. Additional classifications include agency mortgage-backed securities, issued by government-backed entities like Fannie Mae and Freddie Mac, offering lower risk. Non-agency mortgage-backed securities, issued by private institutions without government guarantees, presenting higher risk but potentially higher returns. Commercial mortgage-backed securities, backed by income-generating commercial properties. Residential mortgage-backed securities, backed by home loans for single-family residents. And strip mortgage-backed securities, separates principal and interest components into distinctive investment products. The role of mortgage-backed securities in the financial crisis. During the early 2000s, demand for mortgage-backed securities surged, leading to relaxed lending standards and an increase in subprime mortgages. When housing prices peaked in 2006, defaults soared, causing mortgage-backed security values to collapse. This triggered a financial meltdown, prompting government intervention, including the Troubled Asset Relief Program and large-scale Federal Reserve purchase of mortgage-backed securities. Risk and rewards of mortgage-backed investments. Advantages: attractive yields compared to government bonds, regular income streams through mortgage repayments, diversification benefits within an investment portfolio. Disadvantages: repayment risk. Homeowners refinancing or paying off loans early can affect returns. Interest rate sensitivity. Rising interest rates can lower mortgage-backed security values. Liquidity risk. Some mortgage-backed securities, especially non-agency securities, may be difficult to trade in downturns. The current mortgage-backed securities market. The U.S. mortgage-backed securities market remains significant, with trillions of dollars in outstanding securities. Agency mortgage-backed securities with government backing dominate the market, while non-agency mortgage-backed securities continue to attract risk-tolerant investors. Interest rates and economic conditions influence mortgage-backed securities performance, making it essential for investors to assess risk exposure carefully. Conclusion: mortgage-backed securities play a vital role in the financial landscape, offering investment opportunities with varying risk levels. While they provide income and diversification, they also carry risk tied to economic conditions and borrower behavior. Understanding these factors can help investors make informed decisions regarding mortgage-backed securities as part of their portfolio. If you have any questions or concerns about mortgage-backed securities, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.